The following program is paid for by Lifespan Wealth Management, providing financial advice since 1993. At Lifespan Wealth Management, the main thing they do is provide retirement planning and advice and manage their clients' investment accounts. If you're looking for a financial advisor, contact their office at 478-922-8100 to set up your complimentary consultation. Lifespan Wealth Management has offices in Macon and Warner Robins for your convenience, and you can learn more about them by visiting their website at retirerelax.com. While you're on the site, visit the special report section, which provides great financial education information on many different topics. You can also sign up to receive their digital feeds, which are short videos providing great information relevant to retirement, investing, and matters that affect your money. They also offer seminars to the community at no cost. If you're looking for a guest speaker for your church or civic organization, give them a call to discuss the topics you would like them to cover. Again, their contact number is 478-922-8100. Now, from the Macon studio of News Talk 940 WMAC, it's time for Your Money with Sherry Goss, Randy Goss, Jonathan Eisner, and Corey Albrecht.
Good morning.
Good morning, everyone.
Awesome. So here's something you might want to add to your calendar. It's called the Run to End Alzheimer's, and 2 is the number 2. And it's happening at the Landings in Warner Robins. It's a 5K and a 10K, and it's on Saturday, April 4th. Shotguns start at the Landings Point, which is 402 Georgia Highway 247 South. And this is the intersection of Sandy Run and 247, where you'll see there's 2 guys in a pie and a Cuban restaurant, which is pretty fantastic, by the way. So you can register at run2endalz.org.
Yeah, it's usually a pretty good time. So
yeah,
hope you enjoy yourself when you get out there.
You don't have to run. You can walk.
That's right.
A lot of people walk it.
That's right.
But it's for a good cause.
All right. On another note, be aware of companies sending official-looking documents to you that look like a bill. Every year I get an unsolicited letter informing me that my annual reporting business renewal filing deadline, that's a mouthful, is rapidly approaching. And that's basically the S-Corp renewal with the Secretary of State. The charge for them to complete this is $299.89, but you can accomplish the same task on the Georgia Secretary of State's eCorp website for $60, $40 if you're a nonprofit. And for the low price of $124.95, they will provide the required National Labor Relations Act posters that are supposed to be displayed in the workplace. You can get these online for $32.95. You know, with all the W-2s and 1099s coming in and the federal and state filing deadlines to meet, you could easily miss the fact that this is a solicitation and no action is required on your part. Just simply throw it in the trash. You can spend the same amount of energy filling out the form for this solicitation as you would completing the online renewal on the Secretary of State's website.
Very good.
Good news for homebuyers. Mortgage rates fell finally below 6% this week for the first time in more than 3 years. Welcome news for waves of house hunters heading into the busy spring home buying season. The average rate for a 30-year fixed mortgage was 5.98% this week, the lowest level since September of 2022, and a slight decline from the week before. Mortgage rates briefly topped 7% in January of 2025, but they have fallen steadily over the past several months. Cooling inflation and economic uncertainty have helped bring them down. And the Federal Reserve's 3 interest rate cuts in the second half of 2025 also added to the momentum.
Yeah, I think the long pole in the tent here, it's great that the interest rates are coming down, but the availability of homes, is going to keep the prices elevated. So good luck to the home buyers.
On another note, State Farm announces $5 billion cash-back dividends for customers, specifically its automobile insurance holders, on the heels of a strong 2025, with customers set to receive an average of $100 per vehicle. State Farm announced this Thursday it will give customers $5 billion in dividends. The insurance company said that record dividends will be paid this summer, and the payments will vary by state and premiums paid. The company's spokesman said policyholders do not need to take any action to receive their dividend. Instead, they will receive a check directly or may be notified via email to initiate their payment digitally. State Farm's net income increased from $5.3 billion in 2024 to $12.9 billion in 2025. The payout comes as auto insurers, including State Farm, have faced scrutiny over premium increases in recent years driven by inflation and rising repair costs. After sharply raising rates in 2022 and 2023, some insurers began stabilizing or lowering premiums. State Farm said lowered rates in 40 states in 2025 amounted to $4.6 billion in lower premiums for customers. Similarly, USAA said rates in 2026 were expected to keep stabilizing after it announced $3.7 billion in financial rewards during 2025.
Yeah, they made a lot of money thinking that there were going to be lots of storms, and so that's good that they're paying back some of that money.
For sure.
So it's sad to report that 1/3 of income tax revenue goes to pay the interest on our government's debt. We've talked before about the U.S. budget deficit and how it will grow to more than $3 trillion in a decade. That's $1 out of every $3 going to interest payments.
So that means that this year the feds will pay bondholders about $1 trillion in interest, assuming, of course, interest rates on Treasury securities remain relatively low.
And just 2 decades ago, the government paid $184 billion. A decade from now, it will spend $2.1 trillion, twice what it spends today. As a share of the entire U.S. economy, interest costs have more than doubled from 1.4% to 3.3%, and in another decade, they'll grow to 4.6%.
And we can put it another way. The federal government will be spending almost 5% of the nation's total economic output to pay interest on the debt. The CBO, or the Congressional Budget Office, estimates that if nothing changes by 2036, the feds will be spending more money on interest than any program except Social Security and Medicare, and it'll be twice the defense budget.
That's right, and that's twice the rest of the budget Congress votes on each year. More than double average interest costs over the last 50 years, measured as a share of GDP.
That's pretty disturbing. Think about it. The government will send an amount equal to nearly half of the income taxes you pay to the investors who buy government bonds. That money won't be available for health care, national security, or national parks. If you don't like government spending, think about how much Congress could cut taxes if it was not using the money to pay interest to Treasury bondholders.
Right. And public debt, not counting what the government borrows from itself for programs such as Social Security, will top $32 trillion this year. And do you ever wonder who owns these bills and bonds? Who will collect the interest we are paying? There's a great paper published by the Peter G. Peterson Foundation titled "The Federal Government Has Borrowed Trillions. Who owns all that debt?" And you can look that up at pgpf.org.
Yep.
pgpf.org.
Foreign investors, including governments, own about $9 trillion. The biggest holders being Japan, the United Kingdom, and China. The other big investors are domestic mutual funds and the Federal Reserve, which uses those bonds to help manage interest rates. But in response to aggressive trade initiatives or military threats by the U.S., China and other countries are dumping their U.S. bonds. And President Trump's nominated chair of the Federal Reserve, Kevin Warsh, has for years pushed the Fed to sell much of its portfolio of Treasury securities and other U.S. debt, including mortgage debt.
Yeah, and depending on the degree these lenders sell off their treasuries, interest rates on the remaining bonds will rise, and the share of income tax payments needed to support all that debt will grow even more.
And if the nation faces another bout of inflation, perhaps because of increased costs of goods caused by tariffs, interest rates also will rise, and still more tax payments will be drained by the need to pay interest on the nation's debt.
Reducing the federal debt and the interest costs that accompany it inevitably will require tax increases and spending cuts. Politicians who much prefer cutting the taxes and increasing spending don't make tough deficit-reducing votes unless voters start to balk at the price that they pay for fiscal irresponsibility.
Usually, that pain is framed as higher interest rates. And in fairness, it has been hard to argue that rising federal debt, at least since the turn of the century, has had any impact on those rates. Indeed, we've been in a period of historically low rates for 2 decades, despite the modest uptick in recent years.
The U.S. has been awash in money for consumers and businesses. The fear that massive federal debt could crowd out other borrowing and thus raise rates has proven to be overblown, at least so far.
But you know, the threat of countries selling off their U.S. debt obligations has been a longstanding threat that has yet to materialize in large form, at least. But there's another price for big deficits, less salient perhaps than a spike in mortgage interest, especially since Congress has been happily cutting rates for much of the century. But imagine how much more those taxes could be cut, or how much more government could help families if so much of the federal revenue wasn't going to Treasury bondholders. And I believe that if people could get their heads around that, it could change the way we vote and who we put in office.
Yep, agreed. Okay, next up, spring is almost here. Spring isn't just for deep cleaning your home. It's also a chance to clear out the financial clutter that built up over the winter. Now's a great time to check on your spending, review automatic payments, organize important documents, and take one small step toward a bigger goal. It doesn't have to be all at once, just one thing at a time.
Yeah, and a good place to start is with a review of all the things you've signed up for on TV or an app on your phone. Those 3-month free trials that we all forget about after the first month are a problem and when the charges start. So I'm talking about subscriptions.
I agree, and it's estimated that approximately $27 billion is lost annually in the U.S. due to forgotten or unused subscriptions, and about 55% of U.S. adults maintain at least one paid subscription that they haven't used in the past 30 days.
That's crazy. Streaming services like ESPN Plus, Hulu, and Paramount Plus, food delivery such as Grubhub, and e-commerce memberships are the most frequently unused services. Next, I would suggest doing a paper purge. This is an effective way to reduce physical clutter, which has been shown to lower stress levels. Transitioning to a paper-light life by digitizing documents can alleviate decision fatigue and create a calmer environment. When I meet with clients, I often hear that they are tired of the piles of paper they accumulate and need to get rid of. They even say it is depressing to look at it. And so a lot of them use a shredder. Some of them go to places that'll do mass shredding for them.
Yep.
But it's a thing because it's so easy to just hang on to stuff and just stick it in a drawer.
And the older you get, and when you have all these unsolicited items coming
Right.
in, it just becomes overwhelming. I do remember my grandparents.
Oh my gosh.
Their house was just
the ones in
stacked.
Cartersville?
Yep. The house was stacked. I mean,
You should have
just
seen
piled
this.
high with unopened email, or not email, but unopened mail and piles of newspapers. And it was just so much. They
never threw
it was
anything
too,
away.
Well, it was too tiring for them to carry it all out to the garbage can. It was just extra weight.
I had never
So-
seen anything like that.
All right. And unless you're being audited, you should not need to keep tax records after 7 years. Bank statements after 1 year. And I might recommend maintaining your pay stubs the same length that you maintain your IRS records, though, just in case you're audited. And your credit cards and other junk mail, you should shred those immediately.
Agreed. If you have set financial goals for the year, I encourage you to pull those goals and review them now. Sadly, most New Year's resolutions are abandoned within the first few months, with studies showing that roughly 64 to 80% of people give up on their goals by the end of January or February.
And, I think having a reset, like every quarter for
Yeah.
your New Year's resolution would be a good thing. And this is kind of what we're talking about here.
Or as I approached it, as in my mindset of this is just don't set a goal at all. Then you can't break it. My buddy hurt his hip. He was hobbling to my son's baseball practice yesterday. I said, "Man, what did you do?" He said, "I hurt it working out." I said, "That's why you don't work out, because you're going to get hurt." I'm joking, of course.
Exercise skills.
Right. As we move into March, recommit to your goals. If your goal is to save more money this year, take the time to automate the process. According to the Consumer Financial Protection Board, people who automate their savings are 2.5 times more likely to succeed in achieving their savings goals compared to those who do not automate.
Yeah. Even if you just put $20 a month away, you'll be creating a pattern and a shift in your mentality about savings. As you free up areas of spending because of a good budget, you could add additional dollars to the saving arrangement, and pretty soon you'll start seeing the balance creeping up in that account. And it's really a good feeling when that starts to happen.
For sure.
So we hope you take the time to do something good for yourself this spring. Freeing up the clutter, reinvigorating your New Year's resolutions, picking up on a savings promise to yourself are all positive. A little cleaning and tidying up in your personal life can go a long way to improving your health and disposition. And I will tell you that I have clients that have never thrown away any piece of paper they've ever received. And they have got to start going through these boxes and drawers. And most of it doesn't really even need to be shredded. If it doesn't have your personal information, if it just has your name and address on it, you don't have to shred it. If it has an account number, full account number and all of that, yeah, you want to shred those pages. But there's a lot of stuff that doesn't even have to be shredded. It's just junk.
That's right.
So just set it free.
But the reality is that shredding isn't really that hard to do. I mean, I bought a shredder, a personal one, for $40 on Amazon.
That's right.
And it sits in our home office, and it can hold a lot of paper at once. You empty it every couple months. I mean, it's
But like Sherry's talking about, when you open these documents, this morning, as an example, we had 6 large envelopes that came in, and they were prospectuses from some funds that we bought. The only piece that needed to be shredded was the very front page, and I didn't even have to shred the entire amount of that page. Just ripped off our address, and other information that was up there. And that was like a quarter of the page. The rest of it went directly to the garbage can. So you don't have to spend half your day shredding, just knowing what is important to shred and what
Account numbers.
doesn't matter.
socials, accounts,
Yep.
birthdays. Yep, agreed.
All of that. All righty. So we recently partnered with a company called Vanilla, and this program can help you create a will, power of attorney, and advance directive free of charge, which is awesome. This is available to the public, and if you're interested, please email Corey, C-O-R-Y, at rfmoney.com so he can send you the link. I hope this inspires a lot of people to get these forms done. And if you're a client, we can notarize the forms. And if not, you can use your bank or credit union. It's a fantastic opportunity to get your affairs in order. And I have to say, I've been bringing this up to every client that I meet with because we're doing reviews of do we have your income correct in the system? Do we have your total assets correct? And I'm going down this checklist that the ladies are preparing for me before all of my appointments. And it's amazing to me the number of people that don't have a current will.
That's right.
And when I bring it up, they're like, yeah, I really need to get around to doing that. But they just don't want to go pay an attorney. This is free.
Yep.
So please, Corey@rfmoney.com if you would like the link.
And I'm going to highlight the fact here that this is not just for our clients.
Right.
So if you need this, call the office or email Corey. Sherry just gave you his email. And this is a great benefit for you. So,
It is. It's fantastic.
All right. And while we're on that subject, you'll need to make a list of all of your accounts, from your bank accounts to your investment accounts. Sherry met with a client just last week who is almost 90, and she has not let her heirs know where her investments are.
I couldn't believe it.
Yeah, it's not written
not
down
here.
anywhere.
And it's not with us. So we can't help because she has accounts spread all over in different banks and stuff.
Yep. And I get that. You may not want them to make life plans based around what they might inherit, but you need to make a list of these accounts, where they are, and what the account number is at the very least. This is why this is the way that they can find the accounts and get them transferred upon your death. I know people don't like to talk about this, but it's really it needs to be put in writing, and maybe just attach the list to your will.
That's what I would recommend.
Sherry wrote the life book in 2007, I believe it was, and it can be found in our special reports page on our website, retirerelax.com. And it's a free download, and it's really a workbook. So it's really designed to have 3 holes punched in it and put it into a 3-ring binder. This is a great resource that gives individuals the ability to catalog the location of their investments and banking accounts, insurance policies, advance directives, wills, powers of attorney, funeral and burial instructions, and so much more. Basically, anything you would want your executor to have access to administer your last wishes, it can be in that book.
And you're not going to get tracked by us if you go to our website and download anything. We're not notified of that. So retirerelax.com, life book, print it out. Maybe, I've suggested in the past, and I've had clients actually do this, give it as a gift to their family.
There you go.
When they have a family gathering, they print it out and they hand everybody one and challenge them to get it done because they know that people aren't dealing with it.
Yeah. I know it's probably a hassle in the short run, but I think you're going to sleep a lot better at night.
Yeah,
go ahead and get these things knocked out.
And one of the cool things in the book is Sherry put in a place where you can maybe put a little history about yourself, just in case you want your kids to know something about you that you really never got a chance to sit around and talk about, and maybe some thoughts about them, and where your goals and aspirations for them. So,
and my inspiration for that was my dad, because my dad sat down at a typewriter, and he was a farmer. It's amazing that he even used a typewriter, but his handwriting was not good, so I'm glad he did. But anyways, he wrote basically a 3-page summary of where our family came from, how they ended up in America, his life, how he was raised, how he grew up. It was all this personal great stuff.
Yep.
And you might even want to do something like that if your family doesn't have anything like that, and your kids and grandkids don't really understand where you guys came from. It might be really fun to go back in time and research that a little bit, and then have at least a summary for them to see how they got here. Just pretty
Agreed.
cool. Pretty cool.
Well, your client was 90, but this is truly something that it's never too early in life to get it done, to get it taken care of, because nobody knows what the future holds. Something could happen to you next week, and so if you don't have your ducks in a row and things assigned to where you want them to go, it could get ugly. And so it's always good to be prepared for the very worst, just in case.
Agreed.
And like Sherry said, feel free to reach out to me to get access to the document builder. It's a great tool that can help you get on the right path without having to spend a ton of money. Advanced documents should always be looked over by legal counsel, but the vanilla program offers basic documents that can help protect your family in the case something does go wrong.
Yep. All right. Moving on to another subject. Another major technology company is making its way to the Magic City. Leading AI innovator Palantir announced in a brief post on X last week that the company has moved its headquarters from Denver, Colorado to Miami, Florida. This marks the AI company's second major move in 6 years after Palantir left Palo Alto for Denver in 2020. CEO Alex Karp previously cited the clash between Silicon Valley values and the company's mission.
Palantir's move joins a massive migration of capital to Florida following Peter Thiel's and Jeff Bezos' personal moves to Miami and Ken Griffin's relocation of Citadel. More recently, billionaires like Google's Larry Page and Sergey Brin, Meta's Mark Zuckerberg, and unnamed others are fleeing California for Florida over a proposed wealth tax.
Palantir is currently valued at more than $300 billion with a B, making it the largest publicly traded company headquartered in South Florida. The company reported a net income of $1.6 billion on $4.5 billion in revenue for 2025, more than doubling figures from the previous year. Projections for 2026 revenues sit at nearly $7.2 billion. And in full disclosure, we hold this stock in our portfolio.
As of late 2025, the company had an estimated 4,429 full-time employees worldwide, with about 600 working at the Denver office. Palantir did not publicly specify how many employees may also relocate to Florida. The Florida Council of 100 and local leaders have hailed the move as a watershed movement that validates Florida as a hub for national security and AI innovation. Florida is building the platform for the next generation of high-wage industries through a program called Ambition Accelerated. I imagine housing prices should start to climb even higher.
Oh, yeah.
You bet.
Big time.
Yep. The Ambition Accelerated initiative, which will feature advertising and branding, is aimed at encouraging decision makers to build or relocate to South Florida. And here's another similar story. Rich Californians flock to Las Vegas housing market as lawmakers consider the wealth tax. We knew this was coming. We've talked about it for a couple weeks now. High net worth Californians are increasingly setting their sights on Las Vegas as they look to reduce their tax burden and protect their finances as a proposed wealth tax looms over the Golden State. New data shows that by the end of 2025, more than 23% of Realtor.com listing views for Las Vegas homes came from Los Angeles, making it the leading source of out-of-market interest.
Isn't that something?
Yeah.
Well, the reason is the price gap is substantial. Los Angeles typical home price topped $1 million in January, while San Jose's median price was even higher at $1.1 million. In contrast, Las Vegas median listing price stood at $465,000, according to Realtor.com. Nevada's lack of state income tax also is a major draw.
Right?
For some people, it's purely financial. They can sell a $2 million home, $2 to $3 million home in California and purchase a comparable or larger property in Las Vegas for less while reducing their outgoing tax burden. The migration trend also comes as California considers a proposed wealth tax that would impose a one-time 5% tax on the net worth of residents with assets exceeding $1 billion. California Governor Gavin Newsom has opposed the measures, warning it could push high earners to leave the state.
What will be interesting is who these people vote into office. So I'm from Idaho, which used to be a very conservative state. Because the land was cheap, the state attracted a lot of people from higher cost locations like California, and these people could pay $1 million cash for house and land, and the new homeowners were just more liberal. The property values have gone through the roof, and so has the congestion, and the voting has flipped completely.
Yeah, Coeur d'Alene is not so conservative
No, it's
anymore.
amazing what
Yep.
it did. So the same thing will happen. It'll be interesting to see what all happens with this movement.
That's right. Well, we've talked about this before, but here's where inflation is hitting the middle class the most. Despite some price decreases in goods and gasoline, 69% of the middle-income Americans feel their income is falling behind the cost of living, up 50% from 2020, according to Primerica data. The cost of food has persistently been in the area where inflation remains high for families, and the latest data suggests it's getting worse. The cost of health insurance is also up. So what can you do about it? Jonathan, what are you doing to save?
Well, I've mentioned this a few times, but the method I have found that works best for me is to save as aggressively as possible earlier in the year. With 6 people to take care of, saving consistently can be a challenge in our house because of unexpected things that always are around the corner, seemingly.
And stuff that breaks.
Yeah, and stuff that breaks, exactly. So I can't rely on saving what I need to save if I let too much of the year go by before I start doing it. So most of our extra money in the first few months of the year always goes towards our retirement accounts
So
first.
you do make resolutions.
I do. They're just not spoken out loud or with definitive timelines.
Yeah, when I lived in Florida, I split an apartment with friends, which made the expenses a lot more manageable. But for people that have to live on their own and they don't have friends or a spouse to help chip in on the costs, housing alone can easily drown out their earnings. When you start to add rising car, insurance, and food prices to that, it can become unmanageable. Just because costs are going up 30% doesn't mean that businesses are seeing a 30% increase in revenue. So that increase is not making it to the employees, and they're getting left behind. I think Sherry recently talked about this on the news, that if your job is failing to sustain the rising costs and you're offered a job with more money, then it's something that you need to actually consider and invest in your own future.
Right. So when I got my first professional job, I needed new clothing, and we were busy raising 2 small kids and fixing up a house. And so I found a thrift shop, and that's where I bought my clothes. It's amazing what you can do if you really focus on it, if you really try. So I was vice president of Consumer Credit Counseling Service in Atlanta, and we won a national award for the number of people we had been able to get out of debt and the number of educational programs that I had presented in the Atlanta area. So we attended an award ceremony in California. You know what I paid for my evening dress? $10. When I told my coworkers, they just laughed because I was such a cheapskate, and they already knew it.
But you look gorgeous in it.
And it didn't matter. It didn't matter that I only paid $10. I looked just the same as anybody else in the room.
That's right.
And in fact, when you were going all to those things, when you were in the military and we had to go to all those events, I wore the same dress to every single one of them. Nobody cared. You just don't have to spend money that you don't need to spend.
That's right.
So see if you can't make some changes.
All right. We'll be right back after these messages.
You've been listening to Your Money, brought to you by Lifespan Wealth Management, proudly serving Middle Georgia for over 30 years. Our mission? Helping folks just like you plan for a secure and stress-free retirement. Need a trusted financial advisor? Call us today at 478-922-8100 and schedule your complimentary consultation at our Macon or Warner Robins office. Want to learn more? Visit us anytime at retirerelax.com. Because when you plan smart, you can retire and relax. And here's something extra. We offer free educational seminars for the community. If your group needs a guest speaker, give us a call and let's make it happen. That's 478-922-8100. Now, let's get back to the show.
All right. Next up, how long after filing will you know if the IRS chooses to audit you? Filing your tax return can feel like the finish line, but for many people, a quiet worry lingers. Will the IRS come back with questions? The short answer is that most people who are audited usually hear from the IRS within the first year or two after filing. Now, that seems like a long time to me to be worrying about it. At the heart of this is the IRS's self-reporting system. You calculate your income and deductions, file your return, and the agency checks it against the information it already has. An audit only enters the picture when the IRS believes something in your return may be inaccurate or needs proof.
Yep, here's when the IRS usually audits a return. Audits typically involve tax returns filed within the last 2 years, as Randy just mentioned. By law, the agency can usually audit returns going back 3 years from the date that you filed. That 3-year window covers the vast majority of audits. As you may expect, there are exceptions. If the IRS believes you left a large chunk a large chunk of your income, generally 25% or more, it can go back as far as 6 years. In rare cases involving suspected fraud, there is no time limit at all. Still, for the average filer, the risk drops sharply once a few years have passed without hearing anything. Don't worry, Randy. Don't stress. Just wait 3 years, man. It's fine.
I'm like,
in 3 years, everything will be fine. Or maybe 6, or maybe 7, or maybe never.
Or never.
Yeah, don't stress.
Now the question is, how does the IRS choose who gets audited? One of the biggest myths about audits is that it's always triggered by something you did wrong. In reality, there are 3 main ways returns are selected. Some audits are purely random. The IRS audits a small number of returns each year just to test its systems and keep the overall process honest. These are not personal and do not mean the filer did anything suspicious.
More commonly, returns are flagged by computer screening. The IRS compares your return to others like it. If something looks out of line, such as unusually high deductions or income that does not match reported forms, the system may flag it for review. A human examiner then decides whether it's worth pursuing further. The third path is related examination. If the IRS audits a business, investor, or partner you are connected to, your return may also be reviewed as part of that broader picture.
Yep. And so what raises red flags for the IRS? Well, there is no single mistake that guarantees an audit, and the IRS updates its criteria every year. That said, certain patterns tend to attract attention more than others. Underreported income is a major one, especially when it does not line up with the W-2s or investment forms are already sent to the IRS.
Right, and large charitable donations compared to income can also stand out. The same goes for heavy business losses, unusually high expenses, or investment income that seems incomplete.
Yeah, even rounded or estimated numbers used too often can look suspicious if they do not match the typical reporting patterns.
What actually happens during an audit? If your return is selected, the IRS will notify you by mail, not email, not text, not a phone call, not a surprise visit. The agency will explain what it wants to review and what documents you need to provide them. Many audits are handled entirely by mail. You send copies of receipts, statements, and other records, and that's the end of it. Some audits require an in-person meeting at the IRS office, where you answer questions and present documents. The most serious cases involve field audits where an agent visits your home, business, or accountant's office.
So, possible outcomes you should know about, though. Many audits end quietly, and most of the time there are no charges or changes in the returns. The IRS accepts your return as filed. Another frequent outcome is an agreed change where the IRS adjusts your tax bill and you choose to accept it, pay what is owed, or set up a payment plan. So if you disagree with the findings, you have the right to appeal within the IRS or take the issue to court. So let's hope none of us get to that point.
So when I had my own S corporation while working with Steve Rosenberg, I was an independent advisor with him. I was audited twice, and it was not fun at all. They showed up in these outfits with these, like a badge on their whatever, like a sheriff's badge,
lapel,
and they sat in my office for 3 hours digging through my checkbook and looking for something that was wrong, and it was exhausting. So make sure everything you do and how you report is accurate. And the reason that I got selected, which I didn't understand until later, is if they find that a group of people is doing something wrong, that's where they go and they do a random search.
That's right.
And that's how I got selected, is financial advisors were not claiming all of the assets, all of the income that they were making from their clients, and it was a problem. And so but I got picked twice, and Steve never got picked once. And I went to him.
He was sweating bullets.
I'm like, why aren't they talking to you and not me? You've been in this longer than I have.
He was like, do not send them down this hall.
Right.
It was so funny. But yeah, they couldn't find anything, and they were actually frustrated. They couldn't find anything wrong. So that's what you want.
I wonder if they ever do an audit and figure out that the client actually overpaid, and then it's like,
I'm sure they do.
well, we owe you money. We'll just be on our way now.
I doubt that.
Yeah, me too. All right, tax preparation versus tax strategy. The difference matters more than you might think. We all know that April 15th is the end of tax preparation season and the annual deadline for completing and filing your return for individual filers. As important as proper tax prep is, some see it as part of a broader year-round strategy, which includes reviewing income, investments, and giving opportunities with an eye toward managing lifetime goals. By its nature, tax preparation looks backward, and when the year ends, opportunities to impact that year's results are very limited. The year-round attention we provide looks at past, current, and future income, portfolio structure, and capital gains. This broader awareness does not always produce a refund, but it can sometimes mean making decisions today to get better positioned for the future.
With taxes touching almost every aspect of your financial life, several areas deserve recurring attention, such as income timing. Some types of income or deductions can be shifted between years, which may help with managing brackets. Not all income is flexible, but items such as bonuses, self-employment income, and certain retirement distributions may allow for timing decisions. And then there is tax-advantaged investing. Taking advantage of accounts that are designed to manage income and grow tax-deferred can help with long-term liabilities. Here are a few recent changes that we have monitored as part of your overall tax strategy. 401k limits rose to $24,500 in 2026 with an $8,000 catch-up contribution. Secure 2.0 changes require certain high earners over the age of 50 to make catch-ups in post-tax Roth IRAs rather than traditional pre-tax IRAs. Next, super catch-ups for age 60 to 63 began in 2025 with an $11,250 limit for 2026. And last, with most retirement accounts, once you reach age 73, you must begin taking required minimum distributions. And it's amazing how many people don't know this. It always shocks me when people ask me, when do I have to start taking money out of this? It's not a common knowledge thing. Roth accounts are the exception. Withdrawal penalties may apply if you take the money before age 59 and a half. Roth IRA distributions must meet a 5-year withholding requirement to occur after the account holder reaches 59 and a half.
Yep. So charitable strategies can support the causes that you care about while also contributing to tax efficiency. Several One Big Beautiful Bill Act updates to the tax treatment of giving started in 2026. Above-the-line deductions for non-itemizers have been raised to $1,000 for single filers and $2,000 for joint. Now, only gifts that account for 0.5% or more of AGI will be permitted. The limit for qualified charitable distributions, or QCDs, has increased to 111,000.
Roth contributions and conversions. An important tax strategy that we discuss is whether it makes sense to do a Roth conversion. This is when you roll over your retirement account into a Roth IRA. By doing this, you pay taxes up front and are not taxed when you take withdrawals later in life. You will be taxed on the amount of the rollover in the year that you do it, which can result in a larger than expected tax bill. So care must be taken, and it can always weigh the pros and cons with you.
All right. Tax loss harvesting. Market fluctuations can create chances to use realized losses to offset gains. This involves navigating wash sale rules and coordinating long-term versus short-term positions. It can be an effective, yet complex undertaking. So we're always on the lookout for opportunities to harvest losses if that makes sense to your overall financial strategy.
Estate and gift taxes. The One Big Beautiful Bill sets the exemption at $15 million per person or $30 million per couple, indexed for inflation. Only about 1% of estates exceed this amount, so most of our clients don't have to worry about this any longer. But tax laws evolve, and even permanent rules can be changed by a future Congress and administration. That's why we keep a close eye on potential tax issues. We also consider state taxes that will still apply when developing estate and wealth transfer strategies.
Bottom line, tax preparation captures history. Tax strategy is the year-round attention that, in conjunction with your tax consultant, can shape what comes next and support long-term financial health. As the tax deadline approaches, know that by working with a financial professional, taxes are not a one-day event, but a constant consideration to ensure you are positioned well for 2026 and beyond. If you have any questions or would like to talk with us about your full year tax strategy, please do not hesitate to reach out. We are here to help.
Yep. And just like scam alerts, what would any given episode of Your Money be without an AI update?
That's right.
So here it is. Tech firms aren't just encouraging their workers to use AI, they're enforcing it. AI use is no longer optional if you work in tech. While many sectors are still experimenting with artificial intelligence, the tech industry has moved to the next phase, which is tracking their workers' use of AI tools and enforcing it if they have to. From small startups to giants, including Amazon, Google, and Facebook, tech companies are measuring it with an eye on productivity gains and, in certain cases, factoring it into performance reviews. For some jobs, candidates aren't even considered unless they can demonstrate AI fluency. We're using carrots and sticks, says Beth
Bessernick.
Okay, Bessernick, Chief Executive of Conductor, a 300-person digital marketing startup. The only way to have a thriving company is if you have all your staff having a high level of competency.
Yeah, Bessernick started considering AI use as part of the performance reviews at the beginning of this year for his whole company. Employees get an AI competency score from 1 to 5, scoring a 5 if they can create systems that improve the workflow of others. He's also created a new award. Whoever comes up with the most effective AI-driven process wins a vacation stipend worth several $1,000s. I wonder if he's hiring. Anyway, yeah, he won't consider hiring candidates without AI fluency. During interviews, 2 people sit in to evaluate AI skills. Candidates can expect to be tested on their ability to solve simple problems using AI. They're asked to explain their choice of tools, the prompts that they use, and how they would have done things differently 6 months ago.
Around 42% of tech industry workers said that their direct manager expects AI use in day-to-day work as of late October, up from 32% just 8 months before, according to a survey. And nearly half of tech and telecom companies are already reporting a positive return on their generative AI investments, compared with 35% across the industries. Even in an industry that tends to drive workplace trends, AI adoption hasn't been easy. Tech workers have many of the same feelings about AI as the broader population, including skepticism about how much time it's actually saving them. There's also the added anxiety of hearing their own CEOs talking about how AI will ultimately lead to smaller workforces.
Yeah, I can imagine. Companies can mandate and measure AI use by encouraging a culture of experimentation that celebrates wins and failures. That's much harder to do in large organizations, and not everyone does it well. Several of the largest tech companies are actively measuring employee use of AI. Managers of software developers at Amazon Web Services have a dashboard that outlines engineer AI tool use. And while the use isn't factored into performance reviews, managers do consider who is all in on AI when it comes to promotions. Google is this year for the first time factoring AI use into some employee performance reviews for software engineers. Teams and managers have discretion to evaluate AI use as part of performance based on individual roles and responsibilities, but they aren't required to, according to a Google spokeswoman. She added that the company encourages all employees, regardless of role or level, to incorporate AI tools into their daily work.
Meta's new performance review system will take AI use into account. The system can track how many lines of code an engineer wrote with AI and include AI tools that provide individuals with insight about their own impact, which they can use for self-evaluations. At Microsoft, managers are including questions about AI use in performance discussions. Employees are supposed to quantify how they are using AI tools in their workflows.
Yep. And Salesforce added an AI fluency progress tracker to an internal dashboard late last year. While the company doesn't have specific AI metric employees have to hit to earn strong performance reviews, usage of the new tools and performances are intertwined, according to a spokesperson. So if you're not using AI, you're most likely underperforming. Unlike deploying traditional software where you launch it and people just use it, AI is more complicated to roll out. The company's philosophy over the year has been effectively been to experiment and iterate. The best tools naturally rise to the top and to get adopted widely. There comes a tipping point where enough people are using a tool, and then the mandate comes.
Employees, for example, can now file for paid time off only by interacting with an AI agent. Most self-evaluations and performance reviews, too, are done with the assistance of an agent. This really bugs me. I really like looking somebody in the eye and having them tell me what they think of the work that I'm doing and having an interaction with the actual human person instead of a computer.
Right.
Yeah.
I think it's just like anything else. We're probably going to launch all the way into this thing and then realize that it maybe isn't as effective as we thought and time-saving as we thought, and maybe we're screwing up a little bit because of it. And maybe it reverses a little bit. It's going to be interesting to see.
I don't know. I think this thing's here to stay.
Oh, it's here to stay, but is the amount that we use it is what I'm talking about. For which things? Anyways.
And maybe people will think back and appreciate the time when people looked you in the eye and said,
Yeah.
Here's my
good
thoughts."
job.
Right. Exactly. Instead of some robot telling you good job.
Or they'll look
or
back
not.
and go, who are you?
Yeah. Right.
What did you do for me?
Right. All right, so let's take a look at optional retirement plans for small businesses. This is a big deal. Small business owners often fail to invest for retirement because they prioritize reinvesting profits back into their companies, which they view as their primary retirement asset. This all-in mentality, combined with high perceived costs and administrative burdens of setting up formal plans, creates a significant savings gap. Plus, they're busy. Time flies by, and they just don't get around to creating a retirement plan for themselves.
Right, and profits are frequently funneled into expansion, staffing, and new ventures. Owners often believe that a future business sale will fund their retirement, but there's a little-known fact that only 20 to 30% of businesses listed for sale actually sell. So instead of banking on the future sale, it might be wise to carve out funds as you go along to fund your retirement and let the power of time and compounding interest work for you.
Many owners overestimate the cost of offering a plan. Data shows that nearly 30% of business owners believe that it would cost $20,000 annually. In reality, options for smaller plans can be significantly less.
Especially if they use a SEP, Simplified Employee Pension Plan, which is an employer-funded retirement account where contributions are made to the separate IRAs of eligible employees, which is what we use here.
Yeah. The SEP, much like a 401k, offers higher contribution limits, but the SEP IRA requires significantly less paperwork than a 401k to start and maintain. For example, a SEP can be established using a simple 2-page IRS form, whereas a 401k involves creating more complex legal documents, establishing the trust, and managing ongoing annual filings. We can do all of the above here, by the way, but we would make a recommendation on which one is most suitable for a particular client.
The SEP IRA is a fantastic vehicle for business owners to save for retirement. With the SEP, you can add up to 25% of your compensation, up to a cap of $72,000 for 2026.
And that's just phenomenal for a small business person to be able to save that amount of money.
And I
it's
misspoke
deductible.
earlier. I misspoke because when I was independent, I had a SEP, and I maxed it out every year, and it was the best deal on the planet. Because I'm now the owner of the business, I had to switch to a simple. So anyway, sorry about that. So back when I was self-employed, about 5 years ago after we bought the business, I switched over to the simple, which is in my next paragraph that I already said. What do you know about that? I could have just read that. Anyways, so go ahead, Randy, and take the the next
All
one.
right. Generally, the simple plan
Well, hang on, Sherry. This part's important here. So the 2026 limits for a simple have been increased to 17,000. So this is a big point because
Yeah.
SEPs have that $72,000 limit, whereas simples are only
Yes.
17
17.
Right.
or 21 if you're
Right.
50 or over.
That
so
was painful to have to make that switch.
I can imagine.
Yeah.
I can imagine so. All right, go ahead, Randy.
All right. Generally, the simple plan requires a matching 3% contribution or a 2% non-elective contribution. And I think this scares some small businesses because roughly 37% of owners report that they simply do not earn enough consistent profit to save.
I get that.
Yeah, I know I've met with small business owners who are unaware of the SEP or the simple IRA options. And I'm pretty sure that you have too, Sherry. They all know about the standard 401k, which is a good program, but does require more upfront cost and more ongoing reporting and maintenance.
And, we met with a guy recently here, and he's just getting his business up and off the ground, and he is cutting himself short on the prices that he charges so he can build a customer base. But he does such high quality work. He has more work that he can handle.
Yeah.
He needs to slow down. This is what we try to talk to him about, and offer competitive, not undercut everybody else,
Right.
and then be able to fund his retirement program.
I agree. Yeah, so you were talking about the upfront costs and ongoing reporting and maintenance. So it's true, but many also don't know that under the Secure 2.0 Act, that provides federal tax credits up to $5,000 annually to offset the cost of a 401k because there is a fee to open one. But the problem right now that employers face is recruitment. They simply can't find and retain employees. I'm hearing this everywhere. Offering an employer-sponsored retirement plan is a useful tool for recruitment and retention. 44% of those employers said it was a top 3 reason to consider creating a plan, second only to recognizing it's a need for the employees.
Yep. Some things to consider with any IRA. The traditional, SEP, and simple is that distributions are taxed as ordinary income. If taken before age 59 and a half, it may be subject to a 10% federal tax penalty. And beginning at age 73, you must begin taking required minimum distributions, or RMDs, and these RMDs will be taxed at your current tax rate.
Yep. Okay, switching gears. Financial advice has undergone a radical and potentially dangerous democratization. We're talking about influencers here. 99% of them are not fiduciaries, and for them, it's about getting clicks and sponsors, not about doing what is in your best interest. The new format follows a pattern. A neon lit home office with a 60-second hack that promises to bypass the tax man and save the viewer thousands. These are finfluencers, as they're called, social media personalities who use their platform to promote financial products and share advice.
For the millions in the UK that are battling a persistent cost of living crisis, such viral shortcuts can feel like a lifeline, but beneath the promises lies a financial minefield. But these finfluencers get paid to spread dangerous myths on TikTok. The Times Smarter with Money campaign is aiming to equip the population with the knowledge needed to make big decisions. And key to this is to call for social media companies to take responsibility for influencers sharing irresponsible content on their platforms.
This article came from the Times, a UK newspaper, but this is not just a UK problem. This is
it's
a
a
global
global
problem. Right here in the United States, we're seeing the exact same thing. So I'm glad to see that the regulators have begun to take action. The Financial Conduct Authority, or the FCA there, reported a 174% increase in action against influencers last year, with 3 arrested, the first arrest of their kind. The 3 are set to appear in court in 2027, charged with encouraging followers to invest in high-risk foreign exchange trading.
Horrible. Nevertheless, enforcement is still low. Up to 34 million videos are uploaded to TikTok every day, but the number of enforcement actions taken last year by the FCA, including arrests and written warnings, was just 74. But the FCA cannot prosecute its way out of the crisis, and there are calls for social media firms to do more. The problem is not exclusive to one app or website, with misinformation published on Instagram, Facebook, YouTube, and others. But TikTok's Creator Rewards program pays some influencers based on performance and engagement, a metric that directly incentivizes sensationalism.
Yep. Although there is no publicly available data on the number of videos being uploaded to FinTok, as the financial minded community on the app is known, a TikTok blog posted in May of 24 claimed that there was a 373% rise in video posts for financial content the previous year. The cost of this advice is very real, and 55% of those who have followed financial advice on social media have reported losing money. 55%.
Sad.
Alarmingly, 49% of people don't verify the advice that they're giving. The FCA acknowledges that influencers can offer helpful guidance, but it is targeting unlawful behavior with prosecutions and mass content takedowns.
You know, the thing is, you hear the hype, like, what was it on Reddit? What was the other one where they
GameStop?
GameStop, where they were shorting the stock and people were making lots of money. You had to follow one person, but you had to be sitting there watching it all the time, and you had to do exactly what he said. And that was just one example. But people are they get into the habit of following these people, these influencers, because they have had one or two successes. But like I said here, 55% lost money.
Yeah.
I mean,
I don't know the numbers, but I would venture to say that more people lost a lot of money in the GameStop saga than made.
Absolutely.
The ones that made money probably made out like a bandit.
And those are the ones you hear about.
Those are the ones you hear about.
Of course.
Bob doesn't get on there and go, I just lost $100,000.
Exactly.
I just lost my entire life savings.
Right.
All right. Carry.
One of the big problems is that even when social media platforms remove the illegal content, new accounts pop up in no time with identical or almost identical content.
Yep. Another problem is the TikTok tax experts. Scrolling through posts with the FinTok hashtag, you'll find that's FINTOK, the hashtag. You'll find self-proclaimed experts talking about tax loopholes in bite-sized videos. Yet data from Almond Financial published late last year showed that up to 87% of the financial advice being shared on social media could be misleading.
Terrible.
87%.
Yep.
While the term chartered tax advisor is legally protected, anyone can brand themselves as a, quote, tax expert online.
That's just terrible.
And these experts answer to nobody.
Yep.
Among the claims made in videos is that company directors can cut their tax bill by putting their children on payroll.
Yeah, right.
But you can't just pay a 5-year-old $12,000 for filing.
That's right.
Yeah, you really can't. That's not right. A lot of what is being promoted is sensationalistic, with lots of suspect or incomplete tax advice, and viewers should seek formal advice before implementing anything they see on a TikTok video.
Amen. Even the dream of tax-free company supercars fall apart under closer scrutiny. While influencers claim you can wipe off the tax by buying it through your business, they conveniently ignore the fact that it is classified as a benefit in kind, which could result in a significant personal tax bill. You also typically cannot claim a VAT, or a value-added tax, on a car unless it is used explicitly for business purposes. It's all about getting clicks.
Yep. Next up, shady stock pickers, and this has been around for several years. It isn't only the taxman being cheated, but often savers themselves. Research from Barclays last year found that 24% of investors feel pressure to act quickly on unsolicited advice from social media, a figure that doubles to 48% among Gen Zers. On TikTok, daily videos promote the best stocks to buy, and they are designed to trigger a fear of missing out.
Jonathan Frost, a former fraud specialist, says it's often the hacks that sound too good to be true that receive the most engagement. Social media algorithms are designed to push content towards people who are most likely to respond to it, and that includes promises of easy money and a better life. Once they hook their victims, they guide them towards platforms that offer the video creator the biggest kickbacks. These are typically the very same investment platforms that will fail to pay when victims attempt to cash out. Because these platforms operate across jurisdictions, it's nearly impossible for victims to claw back their money when can't-miss stocks inevitably crash.
Poor regulations play a big role in all of this, but in a fair and balanced approach, not all influencers are peddling misinformation. Nisha Craig followed the rules, and TikTok's AI moderator banned her anyway. The 36-year-old posts under the handle the Fun Money Club and avoids the get-rich-quick rhetoric in favor of practical, low-risk advice with videos on how to use cashback apps or how to sell on the secondhand marketplace, Vinted. Her content, which has an 89% female audience, encourages people to build savings without gambling on high-risk stocks or crypto. She makes money through referral fees for sending her followers to legitimate websites, but despite playing by the rules, her account was banned. She said she cried for a whole day when that income stream was cut off, and she still has no idea why it happened despite making appeals.
Yep. And in August, TikTok replaced hundreds of human moderators with AI, shifting the bulk of the safety work to systems it said could detect 85% of harmful content. But in cases such as Craig's, the system failed to distinguish between a scammer and a legitimate user. Craig said you can't speak to a human anymore. You can't plead your case to anybody. You're at the mercy of a bot. After Times Money approached TikTok press office, Craig's account was reinstated with the warnings were removed. So, guys, we're going to just kind of roll this up here and say, you can go out and listen to stuff on TikTok all day long, and you're going to find something that appeals to you. But you need to be very, very careful, because you have to understand these people are
ulterior motives.
Ulterior motive is to get clicks and to get sponsorships
And kickbacks,
Yes.
and a kickback. That's what it's all about.
And
for
your
them.
money.
And we do offer complimentary consultations. So if you'd like to come in and get some real advice, please come see us.
Real advice. I like that. Not Finn advice.
not Finn advice.
Real
Yeah,
advice.
Real
in
advice.
person with a person.
Our number is 478-922-8100. Have a great weekend, everybody.
Thanks for listening to Your Money, produced by Lifespan Wealth Management. As financial advisors, the main thing they do is provide retirement planning and advice and manage their clients' investment accounts. If you're looking for a financial advisor, please contact their office at 478-922-8100 to set up your complimentary consultation. You can learn more about them by visiting their website, retirerelax.com. And if you have a question or a topic that you would like them to cover in next week's broadcast, you can email Randy at rfmoney.com. They look forward to connecting with you next week. Have a great weekend, everyone. Securities and investment advisory services offered through Osaic Wealth Incorporated, member FINRA SIPC. Osaic Wealth is separately owned, and other entities and or marketing names, products, or services referenced here are independent of Osaic Wealth.